We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Gayed, portfolio manager and publisher of the Lead Lag Report. How are you today, Michael?
I'm a lot better now that you're interviewing me.
Well, you're a busy guy. You've been doing a hell of a lot of interviews lately, and it's good to be able to catch back up with you here. So, being as it is that it has been a long time since we've last spoken, I'd like to start of kind of getting more of a macro view with you. So, of course, we've seen many of the highest prints for inflation in many, many years here. So do you see more of these inflationary factors stacking up at this point, or are you more of the view that we will start to see this rate of change slow down year over year here?
Yeah, and I will say, by the way, given that now I'm playing the role of interviewer like you do, you know, just as I do, how hard interviewing somebody actually is. So kudos to you for all the work that you've done over the years. I have a lot more respect for people that do this, more regularly than I do. It is not an easy game, folks. Okay, so let's talk about this year and this bond market movement, because this, and I've been very public in saying this, has been effectively hell. Mm-hmm. I mean, this environment has been complete hell. And some people hearing that would say, well, what do you mean the S&P is only down, 7-8% off its highs at this moment? And how could you say that's hell? Because it's more than just about the S&P as the quote unquote stock market. Mm-hmm. Barron's had a piece making the case that, or showing that, this is the fastest move in 10-year treasury yields in 2 centuries, 200 years. Mm-hmm. That this is this is one of the biggest drawdowns, if not the biggest drawdown, in the aggregate bond index in 25 years. There has been severe loss and pain in the fixed income bond market. Now, arguably, that's been the case for a while, right? Because inflation's been higher than yields for a long period of time. Negative real rates have been a thing for a while. But the speed with which the bond market effectively crashed, I think, is not only wildly disturbing, but also has broader implications on equities, which we can talk about. Mm-hmm. And why has that meant that in my world it's been held? Well, because treasuries, from all the studies I put out there, from the funds and the indices that they benchmark against, most outperformance comes from getting the treasury trade right when you're in a corrective environment, meaning when you have high volatility in equities. More often than not, historically, there's a flight to safety. Treasury yields drop, money goes into government debt. Except this year, where you have volatility in equities, and it's been the exact opposite. Risk off has actually been risk on, and worse. Right? At some point, that has to naturally change, because it's not just a chart that you're looking at, it's the literal cost of capital that you're looking at when you look at yields moving as fast as they have. Mm-hmm. But I find it hard to believe that won't have meaningful implications quicker than people realize on inflation expectations, because the more that yields spike, the more that the bond market sells off like this, now it becomes much more expensive for companies to finance. And that will have a slowdown effect on corporate earnings. That'll have a slowdown effect on the global system. And I think probably brings down inflation faster than most think.
Mm-hmm. So, when we think about the yield curve, of course, many people watch it very closely for when it starts to invert and the signal that really puts into the market. So is the risk of a recession strong to you here, or is it, again, in this kind of topsy-turvy world, is it too early to be able to tell that?
Yeah, I mean, the question of whether it's a recession or not is tricky, right? It's like even the NBER, they announced recessions after they've already been underway for a while. Mm-hmm. You can make an argument that Europe is probably already in recession. You can make an argument that the US is also probably right now, as we speak, in a recession. Why am I saying that? Because inflation is probably higher than CPI, which means that your real growth in the US may already be negative. Mm-hmm. I mean, we could already be in it when you factor in inflation. It's money illusion in terms of seeing how strong the economy is when if it's largely inflationary driven, then who cares, right? It's mm-hmm. It's not real. That's the whole point of calling it real growth. So I do think that it is very plausible we may already be in a recession. It's also very plausible that the stock market just doesn't care. Okay, and this is also an important thing too. Characteristically, when you're in a recession, what do you see? You see lumber weak. Okay, that's starting. You see defensive sectors leading, utility, staples, healthcare. That's taking place. You tend to have your broad market average below a 200-day moving average. That's still in play. And yet we're still hovering relatively close to the all-time highs. Now, if stocks are a discounting mechanism and we're either in a recession or entering one, you would think the S&P should be a lot lower, and it still could be. But it's always tricky in terms of thinking about how we may be in a recession, maybe entering one, and what to actually do about that from an investment perspective. That's why I referenced that, because it could very well be that the stock market just won't care.
Mm-hmm. So, you and I have both been kind of toying with the broadcasting or the doing the Twitter Spaces thing. It's an interesting medium where our people that want to tune in can actually interact and ask questions. And doing research for today, I had tuned into yours right before this interview, and your guest was talking about the kind of the supply chain breakdowns within China right now. And, that got me really thinking and wondering if you really see the aggressive interest rate stance and hiking stance that the Fed has taken here, if that's going to have an effect on, the actual pieces of or the causes of inflation here that are actually taking place, or if it's more so just in some ways a backhanded or a roundabout way to get at basically destroying demand, as you said, raising that cost of capital for these companies.
Yeah, no, it's a good point. Okay, so there's several schools of thought. I tend to lean more on the idea that the Fed really can't do all that much. They have to undo a lot of the insane liquidity measures, obviously, and they do have to raise interest rates. But I do believe it's hard to counter cost push inflation with higher interest rates that affect demand, because the cure to cost push inflation, where commodity prices are spiking, is the commodity price itself. You don't need the Fed to raise the cost of capital. The cost of things has already increased to break that to cause demand destruction. So I keep going back to this point that spiking inflation is actually deflation, because that ends up meaning that at some point people start saying, well, I can't pay for this anymore. Let me buy lentils instead of meat, right? To use the kind of Bloomberg point. Okay, so everyone's concerned about the Fed raising rates. The reality is the best thing that can break inflation is going to be the dollar still doing what it's doing. Okay, so this is the other part which I think is underappreciated. The dollar has been unrelenting. Now, yes, unequivocally, obviously much more so towards the euro than other countries, but an appreciating currency tends to have a disinflationary effect. That's no different than the Fed raising rates, right? It takes liquidity out of the system because you can no longer import that inflation. You're actually exporting it. Okay, so the fact that the dollar has been strong while commodities have been strong is very curious. You've got, on the one hand, the cost push saying, no, prices have to be higher. On the other hand, you've got this disinflationary force of an appreciating currency. If the dollar were to keep doing what it's doing, I think that alone is going to probably cause the Fed to pause, because the U.S. cannot handle an extraordinarily strong dollar. And that's also, I think, the fastest way to break inflation faster than people think, right? So these things move in cycles. I just think that the focus on the narrative that the Fed can control this inflation, there's already other things that are outside the Fed's control that are trying to control that inflation just from market natural forces. And regardless, an interest rate at 3-4% is not going to get you more grain.
Mm-hmm. And kind of in that vein of getting more of these raw materials, as we're seeing this trend of deglobalization really pick up speed here. Do you see that it is possible that we start to see this wage and price spiral really start to take hold here as well?
Yeah, maybe. I think there's other macro trends at play. Maybe sort of the broader return of unionization, giving more bargaining power to workers. I think those are things that are themselves going through their own kind of demographic cycles, which would argue for wages to continue to go higher, and maybe at some point end up having positive real growth as opposed to the negative like we've seen the last several months here. But again, this is very tricky to think through, right? Because, okay, so let's talk about China. So you got these lockdowns, supply chain disruption takes place. So the argument's going to be, well, you bring in those supply chains to your own borders, right? Just you end up having more control of the supply chain. Well, the problem is that's hard to do because the cost of labor in the US is so much higher than the cost of labor in China. So that argues the point that your iPhone would be a hell of a lot more expensive if it's produced in the US, at least en masse. Okay, well, so you think on the one hand that will be bullish for wages, for incomes, okay? Because you're going to hire more people, and that those come at a premium. But then there becomes another calculation. Well, do you hire those people because you've got to now bring those supply chains in the U.S., or do you literally automate every single aspect of the supply chain because you're starting from scratch and now do so within the U.S. Right? So my point is, I'm giving you kind of a wishy-washy answer on purpose because it's not clear how it plays out in terms of longer term trends. Because I think there's so many counter forces that can just suddenly kick in that make that narrative go away.
Yeah, and I mean it's such a complex system to be able to think through that. Even if we wanted to onshore some of this capacity, there isn't necessarily the ability to do it without the major infrastructure spending to be able to build something like a rare earth element smelter facility or something like that, right? That takes years to be able to not necessarily just build, but permit and find the right place to do it.
Right, and I think that's important, right? Because I always go back to this point that people are so short term in their thinking, and they're so used to instant gratification, they forget these things take a hell of a lot of time.
Yeah, absolutely. So, I'd like to go back kind of to the interest rate thing that we were talking about. The math works out to every 1% of interest rate hike equals something like $300 billion per year more to service the current debt. So is it possible that ratings agencies start to downgrade US debt as we keep hiking here?
And by the way, it's even worse than that because now you got to think about the tax receipts too. So you have spiking rates. Okay, so cost of capital is higher also to roll from U.S. government debt. Oh, and by the way, those spiking rates could cause a bear market in equities. Well, now you've got less capital gains to tax off of because there are losses. So you end up having this double whammy on the U.S. fiscal side. So yes, I alluded to this idea back in mid-June or July of last year in the lead lag report, and obviously I was wrong in making the case back then that intermarket movement was looking eerily similar to 2011, just before S&P downgraded U.S. credit quality. There is, and I've been putting this tweet out quite a bit on that lead lag report. At some point, the credit rating agencies have to say something. And you can be a conspiracy theorist from here until tomorrow about whether they have the internal cojones to actually do that, right? Because that could open them up to lawsuits from the U.S. government. But you'd be hard pressed to make the argument that we're going to have this secular rising rate environment. Oh, and by the way, debt's going to continue to rise. Oh, and by the way, we're still AA plus on the S&P side or AAA, whatever the rating we're being assigned. So that I do believe that's still very much a risk, right? That people are not appreciating. And by the way, the odd thing about a credit downgrade is that it may actually break inflation too. Because what happened in 2011 when that occurred was, yes, 10-year yields dropped, even though it was U.S. credit quality that was being questioned. Actually, U.S. government debt did quite well, but you had credit spreads blow out. You ended up having a crisis with the Eurozone. You ended up having stocks go down 17% in 3 weeks. The stock market is also a disinflationary force, right? Because of the wealth effect. So all this ends up being very interconnected in a lot of ways. Everyone's concerned about inflation. How do you break inflation? Well, if you got to break inflation, you got to break the stock market. How do you break the stock market? You get a credit downgrade on U.S. debt. I mean, you can make an argument that all this ends up coming full circle.
And I think, one of the other pieces of that I was trying to think through as I kind of came up with that question is what does that do to, foreign buyers of U.S. debt? Does that create a race for other countries to start to dump U.S. treasuries?
Well, I mean, I think you often hear that argument, but it's often, you got to be careful of that, right? Because there's like a mutually assured destruction aspect to that. Right. It's just like you hear these lines that, well, China owes the U.S. because China buys so much U.S. treasuries. OK, but they're doing that because we are the demand for all their factories. I mean, there is this sort of mutually assured destruction component to that. Now,
that $350 billion trade deficit, right?
Right. So that's what I'm saying. I think it's hard to really sort of think through how foreign entities respond to that. because they also still have bigger problems than we do.
Mhm.
I go back to Europe's probably already in recession, right? The ECB seems to be the big laggard on any kind of tightening, nor can they really do it when you're in a recession now, when Brazil started doing it last year, right? So the U.S., I hate that cliche. It's like, oh, we're the cleanest dirty shirt, but unfortunately, it's still true. I say unfortunately because you want to be clean. You don't want to be the cleanest of the dirtiest.
Mhm. Yeah, you don't want to be the best of that relative measure.
Right. It's not, okay, great, but it's like you'd hope that there's actually improvement in the fiscal situation of the U.S. government. So again, going back to, I always preface this. I tend to be more of a deflationist at heart,
Mhm.
right? It's just, I still think demographics are against you. I think technology is against the inflation argument. I think the wealth gap is against the inflation argument. If the supply chain disruptions end up cooling and you go back to that world, then suddenly we're going to look back and say Treasury yields at 3% on the 10-year may actually have been one hell of a buy, as opposed to everyone saying, well, yields are going to keep rising, but what's that thing about interest expense again?
Mhm. When you say technology is against us, do you mean that when technology makes things more efficient, that becomes deflationary? Is that kind of the aspect that you're mentioning?
Yeah, no, that's exactly what it is. It takes labor out of the system. And
Mhm.
listen, the reality is, I've talked to several ETF issuers that are launching funds that purely use artificial intelligence. I mean, our industry is getting replaced at some point too by this stuff, by computers and algorithms making the decisions, not us. So all that is still very much in play. That's not going to change.
Mhm.
What is, and the other thing too, which I think is not talked about a lot, is all this that's happening may end up forcing a lot of money into the commodity space, into the ag space, to make it also more technologically efficient. Right. I mean, I think this is something which is a longer term idea that you're going to see in general money flowing into the commodity space to make either recycling more efficient, right? So that we don't have to depend on new materials coming out of the ground. All that is still coming, and it's a lot easier to implement technology on old school domains and ways of the world working when you have a crisis.
Mhm. Yeah, that really goes back to that old saying of the mother of invention is necessity, right?
That's right.
Mhm.
Exactly right.
So you and I have spoken many times before about certain relationships that you watch. So are there any of those relationships that relate to inflation or interest rates that you watch, or do you look further upstream than that?
Yeah. So this is and sort of going back to this environment has been hell, right? So treasuries have not acted like the risk off asset. It's why all of my funds in the ATAC fund family have not fared very well, even though there have been plenty of times in the past where they have. It's just when you're in an environment where treasuries are selling off and not the risk off asset, well, what do you do when you're going risk off?
Mhm.
The only way to go through hell is to keep going, right? So what's been frustrating even within that context, though, is that, yes, yields have been rising, but the areas of the market which are sensitive to falling yields have actually been the strongest. So what am I referring to? Usually when the utility sector, most boring sector of the stock market, when utilities are strong, you see interest rates are going down. Why? Because these are very highly levered entities. So most of their revenue is regulated. They can't raise prices on electricity by 30% next month without political upheaval. So most of the earnings variability is driven by the variability of the cost of capital. So cost of capital drops, they benefit. Well, cost of capital has increased, but they've actually outperformed. Okay, well, what about consumer staples? Yes, the need sector of the stock market. But consumer staples often do well when rates are also falling, when the demand for money is falling. Why? Because of how much of their total return is driven by dividends. Healthcare, a similar dynamic. So you've got interest rate sensitive groups outperforming while interest rates have been rising. Very, very abnormal historically.
Mhm.
Now, that then begs the question of who's right, because there's a clearly different message. On the one hand, internally within the marketplace, there's a bet that the cost of capital is actually going to fall pretty aggressively because the demand for money is falling. On the other hand, you have still an unresolved turn of trend in yields where they're still rising. From my own studies, usually the sectors tend to get it right, not the asset class. Meaning you would think that if utilities keep on outperforming, staples keep on outperforming, if lumber to gold is still weak, that yes, you are going to see a hell of a run back into bonds, in particular treasuries. It's not happening just yet, but people forget markets tend to not be that instantaneous. You can have the bond market crash first, and then you can have stocks crash afterwards.
Mhm.
It doesn't have to happen on a coincident basis. It can just be one of those things where there's a delay, and the area which everyone suddenly said is never going to work suddenly starts to work again.
Mhm. Yeah, in some ways, you have to take the same basic view of some of these long-term gold investors, where I have been kind of pointing out that we a lot of times don't have to worry about the day-to-day fluctuation and take more of this longer-term view if you really understand it. And as from your standpoint, your funds, you've put the time into to write those award-winning white papers to understand these relationships, and it's just going to take time to play out, hopefully, right?
Yeah, and it's, you never want to change an approach based on an anomaly
or emotions.
Or emotions, right? And emotions are driven by the anomaly too, right?
Mhm.
It's like, it's not just my funds that have been played with this year. A lot of these funds that are tail risk funds, they benefit when there's high volatility. They've all been horrendous, and they've been horrendous because your opportunity set has been horrendous in terms of treasuries as the defensive asset. Now, I spoke to somebody not too long ago who said, well, shouldn't it have been obvious that the Fed raising rates meant that treasuries wouldn't be a safe area? The Fed doesn't control long rates. They control short rates. Even with QE, they could never control long rates. Every time the Fed did quantitative easing, what happened to long rates? They actually rose. Except this time, of course, right? As far as the tightening goes. And every time they tighten, what happens with rates? They end up falling. So the narrative around bonds, I think, is first of all, it's chasing price. We know that narratives follow price. I also think it's just vastly misunderstood the interplay of bonds and stocks, and why this environment is unlikely to persist in any real way. Because if the environment persists, again, I go back to how the hell is, and exactly your point, is the U.S. government going to handle all of this debt if you're in a secular rising rate environment? Oh, and by the way, you don't even have political willpower to pay off that debt. It doesn't make sense.
Yeah, absolutely. So, when we think about the utilities, let's say, for example, we think about the cost of energy as well in there: oil, electricity, natural gas. How much of a war premium do you think is priced in at this point? Or do you think the market has really digested the conflict at this point?
Yeah, good question. I don't know how much U.S. markets have priced in war. I think European markets clearly have priced in war much more because they're much closer to it, not only geographically, but also in terms of the way these key commodities, which come from Russia and Ukraine, are directly impacting them, right? On the utility side, that defensive posturing, that started a little bit even before the war. So even prior to Russia going to Ukraine, you started seeing some stabilization of relative momentum in the defensive sectors, almost as if there was an anticipation that a slowdown was going to occur. And then suddenly, the catalyst of even more defensiveness occurs when Putin goes into Ukraine. I think that there's still a lot more room for potential outperformance in that part of the marketplace. And I say that because if you are still going to have a bigger risk-off period to come, the sector which still has to have a lot of air taken out of it remains technology, right? So we've seen financials have had a pretty strong about face. Usually people think about financials being the bucket through which capital that sells out of technology goes into. But if you have a broad beta sell-off, which means a broad tech sell-off, that money is not going to probably go into financials as much as it goes into staples, healthcare, utilities, probably more staples and healthcare, obviously. So,
and those would be considered risk-off plays, right?
On a relative basis. So they might be
Right.
down 20% while the S&P is down 30%. And that's still fine, right? They would still give you the down capture in your favor. But my point is that could still persist. This relative momentum could still persist. And by the way, that's an important point too, for the more sophisticated listeners, right? That aren't just doing directional bets on markets. Maybe you don't do a directional bet. Maybe the best thing to do is to go long a need sector and short a want sector, dollar for dollar. So you do what's called a spread trade. That way you're not as worried about where the Dow is. You're simply worried about the relative performance. And that may actually be much more visible than making a directional bet. Because I have to tell you, in this environment, I don't know how anybody can be comfortable whether you're long or short. I mean, this thing can play out in so many extreme ways. Your head spins just thinking about how the different scenarios could play out.
That is an absolutely integral point to every conversation I have, Michael, is it's just, there are so many different, spinning plates in the air that it is almost impossible to try and figure out exactly how this is going to play out. And I think that some humility of admitting that it's an extremely difficult thing to be able to predict is a good thing. So, I want to get a little bit more of your feeling on how institutions and hedge funds are positioning themselves in this time. Are they struggling to make sense of this environment as well?
Yeah, and it's interesting, right? Because institutions are probably going to be what forces yields back down again. Because what's going to happen is, and this is kind of well documented, you always tend to see this kind of end of quarter rebalancing, where if an institution has, say, 60% stocks, 40% bonds, well, if your bonds dramatically underperform your stocks, in order to get back to your 60-40 target allocations, you've got to sell your stocks, you got to buy bonds, you got to rebalance, right? So I do think that there's going to be some support coming in anyway in the form of institutional demand. It's interesting, you used to hear this constant talk about this hunt for yield when it came to the bond market. Institutions constantly want yield. But now that they have yield, you don't hear about the hunt for yield. You don't hear about wanting to chase yield because everyone now is afraid of yields going higher. The mandated exposure to fixed income will not change. I think institutional money in general probably will go back into bonds because they see this as an opportunity if they believe inflation will be controlled faster than the media and the Fed thinks, which is very possible. But again, keep in mind, institutions move slowly and they tend to move on very sort of mandate-based ways. So it's not like you're going to have somebody suddenly do a massive long or a massive short or to put a massive amount of money in bonds. It's going to happen gradually, like a slow-moving ship that's trying to find out exactly where to dock.
And do you feel that bonds are the only, let's say, safe place for those institutions to start getting into, or is it turning towards, or can we see something like that happen for gold, for more of those risk off commodity hard asset based plays?
So I know this world a little bit in the sense that I've dealt with consultants that put out RFPs and deal with institutional allocators. And as much as there's this impression of these people being very sort of static in the way that they think, here's asset allocation, here's an efficient frontier, the reality is they're human beings too. They also want to get their accolades. They also want to get their bonuses. And that means that they're going to favor whatever asset class is working. Right? And what that means is that while gold may not ever have been super enticing in the past 10 years, now maybe the institutions and the consultants and the middle person says, well, this thing's got some uptrend movement. Maybe we should consider putting a 5% allocation. Right? So that's my cynical view on this, is that the more that gold performs, the more it ends up becoming a self-fulfilling prophecy, because the slower institutions start now saying, well, maybe we should have this in our portfolio because bonds are not helping. There's still a paper loss there. Oh, and stocks are very overvalued. So we got to put our money somewhere. You can't just be in cash. So let's try gold.
So do you see a commodity super cycle coming yet, or is demand destruction going to play a larger role in the coming years to dampen this rise in raw materials?
So this is really tricky because I've argued that you still have another debt binge coming at some point, right? Because supply chains are going to be taken internally within the border. So that's going to be a tremendous amount of money that you've got to issue, debt to issue to do that. And you have failing infrastructure globally. You often hear about it from a U.S. perspective, the infrastructure plans, but it really is true. Like, things are crumbling across the board, and it's not getting better with time because we're not replacing things fast enough and making them up to code and all this stuff. So I say all that because I do think that there's going to be this constant underpinning of demand for raw materials. The challenge is whether it's a super cycle or not, which is really more a question of magnitude and time, because again, you have to issue all this debt to do that. Well, what happens if you already have high debt? You can't necessarily just do it all at once, right? So to me, it's almost like a slow drip of demand just is constantly going to be in the background, which makes the asset class attractive. Don't get me wrong, right? But I think it's a question of speed. And I would argue that you actually want it to be a gradual move in commodities because, again, if you have a crisis and it's too aggressive, that actually ends up being harmful to the commodity producers because suddenly now, to your point, demand has been destroyed.
Mm-hmm. And I mean, again, that comes down to a very complex picture because if, as you say, some commodity prices spike, like energy, gold producers, let's say, that need millions of gallons of diesel fuel, that also drives their costs up, right? And
Exactly.
And I think part of that question I wanted to kind of dig into as well was if you think that calling it a broad commodity super cycle is not necessarily the best way to think about it, and we need to think about it more as these certain asset classes, let's say take uranium, for example, to be able to produce nuclear power, if that's the direction that we do see some of these countries around the world heading, if something like that is going to outperform other parts of the commodity space.
Right, exactly right. And uranium's, a lot of people smarter than me are pounding the table on uranium. I've put out some pieces in the past about it, but the more I think about that space in particular, I mean, that's probably true. There probably is a lot of longer term potential there. But again, I go back to, and this is another area we can talk about. Well, how do you play commodities, right, in an investment portfolio? So you've got things like the metals, which are based on spot. Then you've got futures based, where there's a rollover effect, right? So maybe that's the only way you can get access to commodities. I mean, you're not going to fully track the actual current spot price. But that is a consideration, right? Because you can be right in the thesis, but your execution could be very, very wrong based on the vehicle.
Mm-hmm. Yeah, absolutely. So what do you see as some of the most destructive unintended consequences of the sanctions on Russia here in the US?
Yeah, I mean, clearly, I think I don't think most people are aware of how bad food prices could get because of Russia, Ukraine, because keep in mind, all these prices that we're seeing are basically still on last year's crop. So we actually don't know what the true supply is going to be. So we don't really know what the real price is going to look like for food. Hopefully it's less than the worst case scenarios, but Russia, Ukraine, supply chain, COVID, all this money printing, and just simple world population, we were heading towards a food crisis at some point, right? And because there's been so much underinvestment in the space, because there's been no momentum in the space, it kind of makes sense. That will have, I can argue, positive effects on the economy longer term, on the global system longer term, because if the cure to high price is high price and money flows into the space and it becomes more efficient, there's more technology and there's more business development in that area, then at some point, food presumably will be on average lower than what we've seen for many, many years prior, right? So it kind of goes back to this point that there are always these cycles. Commodities have big runs, and then they end up, because of businesses and funding coming in, those prices come back in. In the short term, though, yes, it's very clear. Russia, Ukraine added a lot more fuel to the fire to the pressure on the cost of food. And you're seeing the implications of that with some of these riots in various emerging countries and emerging economies. This is going to take some time to play out. So I think there's still going to be a lot more pain and a lot more societal upheaval. You can call it Putin inflation all you want, but the reality is it's more than just what's gone on with Russia, Ukraine. There's been a lot of underpinning malinvestment that also got us to this point.
And again, kind of to our earlier point, if the cure for high prices is high prices and that drives money into that sector, that's still going to take time to grow that crop, to make those innovations, to kind of get ahead of that trend, right?
Exactly right.
Yeah. Michael, is there anything else you'd like to touch on before we wrap up today's conversation?
Yeah, no, I think the final thing is just, keep watching this mortgage rate side of things, with now mortgage rates above 5%. Who knows if it gets to 6? I mean, everyone says, well, these are still low rates. Okay, but when you have negative real income, it's a double whammy. You're paying more and inflation's more, and you're not making enough to compensate for either, right? So that's going to have disinflationary effects, which at some point will result in treasury yields dropping again, which hopefully results in true risk off, which hopefully is what my funds can benefit off of. But I do think that housing, I keep making this point, housing has got to be where the next real concern comes in. it's not necessarily a situation like 05, 06 where there's a housing bubble and then peak that then results in another great financial crisis. But to argue that housing can continue at this pace of unaffordability when mortgage rates are spiking, not just here in the US, but also globally, and given that most people's wealth is in their homes, that is going to be a hell of a way to break inflation as well, right? Just the natural depreciation of home prices. So I think that remains a really big tail risk source, right? Because again, most major crashes, corrections, bear markets are preceded by housing weakness. Housing weakness may be just around the corner.
So do you think, I mean, kind of back to our one of our points about, relative dirty shirtness, let's talk about relative bubbles. It's not necessarily that the housing bubble that we currently have is the biggest or most dangerous, but in relative size, there are far more bubbles that are out there now compared to that 08, 09 environment.
Yeah, and the counter, of course, is that you have institutions buying up a lot of properties, and they are not going to be forced sellers to market. So you can say, well, the drawdown in housing is not going to be as much as it used to be because you've got these other players that don't need the liquidity, right, to mark those lower prices. But this is global. I mean, I spoke with two subscribers to the Lead Lag Report independently who are each in Australia and one who's in Finland just last week. And I said to them, I was curious, tell me about the state of housing markets in your locations, in your countries. And everything they said, I could have just literally switched the words and applied it to the US. So you do have this global phenomenon, because COVID was global, obviously, where housing is across the board wildly stupid in terms of pricing. And I get all the supply issues. I get all the underinvestment there too. But again, at the end of the day, housing is based on income. Well, if your real income is not picking up, then suddenly it becomes a renter nation, not an owner nation.
Yeah, I would say the same thing is true here in Canada as well. Yeah.
Again, it's a global phenomenon. So that alone is also a little scary, right? Because if it's happening globally, if everything's acting the same way, it's one correlated trend on the upside. Well, what's going to happen when it starts reversing?
Yeah, absolutely. And as you say, that becomes a tail risk that needs to be accounted for or thought of as well, right?
Exactly right.
Michael, of course, you're available on Twitter at Lead Lag Report. You do many Twitter live spaces, and you've also started putting a lot more energy into your YouTube channel as well, right?
Yeah, no, and so it's youtube.com/c/the Lead Lag Report. I'm a little jealous of your subscriber base, Tom. I'm hoping to have, I put these spaces conversations edited there in a different format for those that can't access them. I tell you now that I'm getting involved in the YouTube game, I give you a lot of credit because it is not easy. It is a grind. Everybody that's listening here, you got to give a round of applause to Tom and his team as well, because it is it's hard putting content out constantly, especially when you have other responsibilities.
Yeah, it is. But I really appreciate that, Michael, and I appreciate your contribution to the channel and the somewhat different perspective that you bring as well, and the interesting conversations you have.
Sure.
And then your website is leadlagreport.com as well, right?
Correct. Yes, sir.
Perfect. Excellent, Michael. I really appreciate your time today.
Thank you, everybody. And if you don't follow Pals, hit subscribe, do it, and Lead Lag Report.
Absolutely. Thanks, Michael.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.